The year is 2025. The global economy is teetering on the brink. A recession, a dreaded word in the financial lexicon, is a real possibility. But what exactly does it mean? Simply put, a recession is a period of significant economic decline. It's more than just a temporary dip. A recession is marked by a sustained downturn in economic activity, typically lasting for several months or even years. We've seen recessions before. History is a stark reminder of their impact. The United States, for example, has weathered numerous recessions throughout its history. Some have been relatively mild, while others, like the Great Depression of the 1930s and the Great Recession of 2007 to 2009, have left deep scars. Recessions bring job losses, business closures, and a general sense of economic uncertainty. The question on everyone's mind is whether we're headed for another downturn. The answer, unfortunately, is not so simple. Economic forecasting is a complex business, and there are a multitude of factors to consider. However, the warning signs are flashing, and the global economy is showing signs of strain. The possibility of a recession in 2025 is a very real concern. The specter of a global recession looms large, and at the heart of this economic storm lies a contentious policy: tariffs. These taxes on imported goods implemented by the Trump administration have ignited a trade war with global implications. While proponents argue that tariffs protect domestic industries, the reality is far more complex. Tariffs, by their very nature, disrupt the delicate balance of global trade. They increase the cost of imported goods, making them less competitive in the domestic market. This, in turn, can lead to higher prices for consumers, fueling inflation and eroding purchasing power. The ripple effects are felt far beyond the targeted industries, as businesses and consumers alike grapple with the economic fallout. The impact of these tariffs is already being felt around the world. Global supply chains, carefully constructed over decades, have been thrown into disarray. Businesses are scrambling to adjust, and consumers are facing higher prices for everyday goods. The tariffs have sown uncertainty and instability in the global economy, creating a climate of fear and apprehension. The economic outlook for 2025 is increasingly uncertain, with major financial institutions sounding the alarm about a potential recession. Goldman Sachs, a leading global investment bank, has significantly increased its U.S. recession probability to 45%, a stark warning that the world's largest economy is not immune to the gathering storm. J.P. Morgan, another financial heavyweight, paints an even bleaker picture, estimating a 60% chance of both a U.S. and global recession. These predictions are not to be taken lightly. They reflect a growing consensus among economists that the global economy is slowing down and the risks of a recession are rising. The International Monetary Fund, a global organization tasked with promoting economic stability, has also revised its growth forecast downwards. Citing trade tensions and slowing global demand, the IMF warns of a synchronized slowdown in major economies. The organization stresses the need for coordinated policy action to avert a full-blown recession. Section 4. The Fed's Balancing Act. As the specter of recession looms, all eyes turn to the Federal Reserve, the central bank of the United States. Tasked with maintaining price stability and maximizing employment, the Fed plays a crucial role in steering the economy through turbulent times. In the face of slowing growth and rising recession fears, the Fed's monetary policy decisions carry immense weight. Economists and market analysts are closely watching for any signs of a policy shift. One of the Fed's primary tools for influencing the economy is the federal funds rate, the interest rate at which banks lend reserves to each other overnight. By lowering interest rates, the Fed can encourage borrowing and spending, stimulating economic activity. However, the Fed's room for maneuver is limited. Interest rates are already at historically low levels, and further cuts may not be as effective in stimulating growth. Additionally, the Fed must also be mindful of inflation, which can erode the value of the currency and destabilize the economy. Section 5. A world on edge. The global economy stands at a crossroads. The threat of a recession looms large, casting a shadow of uncertainty over businesses and consumers alike. The trade war, fueled by tariffs and retaliatory measures, has disrupted global trade and eroded confidence in the global economic order. Financial markets, known for their sensitivity to economic shifts, are reflecting this unease. Stock markets around the world have experienced significant volatility, with sharp swings in both directions. Investors are grappling with uncertainty, trying to gauge the potential impact of a recession on corporate profits and global growth. The US dollar, often seen as a safe haven currency, has also experienced fluctuations, reflecting the global nature of the economic concerns. The potential global impact of a recession in 2025 is significant. A slowdown in the US economy, the world's largest, would have ripple effects across the globe. Emerging markets already grappling with their own set of challenges would be particularly vulnerable to a decline in global demand and investment.